Chapter 8 is about the ownership claim on the assets and how we account for the presentation of stockholders' equity. As you're moving through this chapter, you're going to be exposed to, and you should be able to understand by the end, the basic characteristics of common stock and how common stock is presented on the balance sheet, what preferred stock is, and discuss what its advantages and disadvantages are to the corporation, and show how it's presented on the balance sheet. Describe the accounting for cash dividends and the dates involved in the dividend transactions. Those are really important. Describe what stock dividends and stock splits are and why each type is used. Recognize the components of accumulated other comprehensive income or loss, and explain why these items appear in stockholders' equity. You should be able to explain what treasury stock is and discuss why it's acquired, and show how treasury stock transactions affect stockholders' equity, and show how stockholders' equity transactions for the year are reported in the financial statements. Finally, you should know how the presence of a non-controlling interest affects the presentation of consolidated financial statements. So let's get started on just a little bit of a reminder of what stockholders' equity is and what it's comprised of. So stockholders' equity is comprised of paid-in capital and retained earnings, less treasury stock. Paid-in capital includes both preferred and common stock at par value or their stated values, and additional paid-in capital accounts. If you need a reminder of par value, stated value, please feel free to access one of the videos that addresses this for the principles class that is on the YouTube channel. So the stockholders' equity section of the balance sheet reports the dollar value of paid-in capital for common stock at $1 par. 100,000 shares issued and 95,000 shares are outstanding. Additional paid-in capital is listed at $2.8 million, resulting in $2.9 million in total paid-in capital. This organization, through this point in time, has not distributed $1.4 million in earnings, but has retained them and is reporting that in the retained earnings line. There are 5,000 shares of treasury stock that have been reacquired, and this was for an amount of $150,000, leaving total paid-in capital and retained earnings for total stockholders' equity to be $4,150,000. This is the basic presentation of the stockholders' equity section of the balance sheet. Now, because the stock shares have been issued, there's 100,000 shares that have been issued at $1 par value. That is our $100,000. If you know how much par is and you know what the balance is, then you can effectively calculate how many shares have been issued. Then, with the disclosure of how many shares there are in Treasury, you can back into how many are outstanding. So let's take a look at this example. On January 1st, 2016, the company issued 100,000 shares of its $3 par value common stock for $14 per share. We create this entry. Cash is increased for the $1.4 million that was received. That is 100,000 times $14 per share. Common stock is then credited for the par value of those shares. So that's 100,000 shares times $3 or $300,000. And then the difference, the $11 more per share that we received over par value times 100,000 gives us $1.1 million of paid-in capital that we will credit. Our assets increase and our stockholders' equity increase both by 1.4 million on the horizontal model. So let's look a little bit more at common stock. When we go and create our charter, we have a set number, a total number of shares of stock that we have been authorized. Amongst all of the authorized shares, we will have some that have been issued, meaning that they have been sold, they have gone out to the stockholders. We have some that may have been reacquired. We will have some that are outstanding, meaning that they have gone out to the stockholders and they are still out there. Those that have been reacquired are still issued. They've gone out to the stockholders, but they've now been repurchased and are in control by the business currently. And then some that have never been issued. These are unissued. So in the entire pie of authorized shares, we'll have, to begin with, what is unissued and what is issued. And then within what is issued, how many of them are outstanding and how many of them are in treasury. This composition, the composition of this pie, can change depending upon what the strategy of the organization is. As a company engages in a share buyback program, we'll see that the yellow section starts to get bigger and the dark blue section starts to get smaller. Now, you should be relatively familiar with common stock, being it is the type of stock that an organization absolutely must have. So first, we're going to talk a little bit about preferred stock. Preferred stock is a different type of stock, and it is a stock where the owners have traded off some of the normal rights that common stockholders have for some preferences. You could almost think that they trade a little bit of their rights so that they can have a higher sense of security almost. Some of those rights are that typically preferred stock doesn't have voting rights, but preferred stock always has a preference over common stock when dividends are declared. Preferred stock has a par, will have a par stated value. And often that dividend is going to be expressed as a percentage of par. Some preferred stock can be what is called callable, meaning that the organization can reach out to the stockholders and basically force them to sell it to them for retirement. It can be convertible. And what that means is that tied to it is an option that they can exchange their preferred stock for a stated number of common shares. Normally, preferred stock is cumulative, meaning that all dividends must be paid before any dividends can be paid to the common shareholders. Sometimes it is non-cumulative, so you need to see what it tells you on the nature of the stock. Is it cumulative or non-cumulative? If dividends are paid on non-cumulative stock, the company is not required to make up missed dividend payments. So, for example, let's use Matrix, who has 50,000 shares of $100 par value, 6% cumulative preferred stock outstanding. So first, we have to determine what the total par value is. We take 50,000 and multiply that by 100. That's going to give us $5 million a total par. Now it's 6%, meaning that the dividend is 6% of par. So we multiply that by 6%. And we ascertain that the dividends are $300,000. If in 2016 there were no dividends declared, so the $300,000 was not paid to the preferred stockholders, then this amount is owed. It is not entered as a liability, but it is noted in the notes to the financial statements. In 2017, when a dividend is declared, the company must first satisfy the 2016 dividends in arrears of $300,000 to the preferred stockholders, pay the current $300,000 to the preferred stockholders, and then distribute anything left to the common stockholders. Remember, this is only if the preferred stock is cumulative. Preferred stock actually functions similarly to that of a bond. There are quite a few similarities between it for it being an equity and not a liability. Note that both provide fixed claims to income. In the case of preferred stock, it's in the form of the stated dividend. In the case of bonds payable, that is in your interest. Also, preferred stock's redemption value and a bond's maturity value are fixed claims to income upon disposal. Preferred stock and bonds are both usually callable, and they may be convertible to common stock. However, preferred stock dividends may be skipped from time to time. Bond interest must be paid or the firm can face bankruptcy. Preferred stock has no maturity date, but a bond's principal must be paid at maturity. And dividends are not an expense and are not tax deductible, whereas the interest is a tax deductible expense. So in deciding on whether or not to issue preferred stock or bonds, these are some of the things that managers go through. They determine which is going to be in the best interest of the organization, depending upon what their strategic initiative is at that given point in time. The additional paid-in capital accounts for preferred stock and common stock represent the excess of the amount that is received from the sale of the stock over the par or the stated value. The retained earnings account represents the cumulative earnings of a corporation, less the cumulative dividends that have been paid since the business started operations. There is no relationship between retained earnings and cash. Retained earnings does not